Welcome to the Building Web3 podcast. Today, my good friend Robby. He's the founder and CEO of Umoja. A very difficult word for me to say, but Robby is good at it. All right, before we get too deep into your company, give us a brief introduction into your background. How'd you get into this Web3 space?
Yeah, absolutely. Appreciate you having me on. And very brief background. So I've been in crypto since 2011. Got into it in college. One of my friends was building a Bitcoin exchange at the time, and after that, started my career in finance at Goldman Sachs. Switched over to tech at Amazon and ended up leading social impact at Consensus, which created Infura and MetaMask. Which I deployed around a dozen blockchain dApps and initiatives with the Ethereum Foundation, World Bank, a few NUA agencies, and a few major NGOs within the context of humanitarian aid and capital markets. And then afterwards, spun out as Umoja Labs now, and we focus on creating next generation liquid staking tokens.
Absolutely. And for people that are unfamiliar, we've done a lot of liquid staking episodes, but give them a brief rundown on what that specifically means and what's involved in liquid staking.
Yeah, absolutely. So for those who are unfamiliar, liquid staking tokens just means that you have a token that represents ETH that is staked, or some token that is staked, usually to a blockchain network. So most commonly, it's usually ETH staked to the Ethereum network through a protocol like Lido. But there are some concerns and some risks associated with liquid staking tokens right now. I mean, one, APYs aren't very high. It's usually 2 to 4%. And two, there's this concept of impermanent loss. More simply put, if ETH goes down in price while your ETH is staked, then your liquid staking token also goes down in price. And so you're really kind of beholden to the base asset that's staked and the risk associated with that asset. And so next generation liquid staking tokens have more customizable risk and APYs by putting that capital in different places than just the network, like leveraging high frequency trading or DeFi vaults or arbitrage across centralized exchanges.
Absolutely. So let's go into what your company's mission is and how you guys are hoping to accomplish it.
Yeah. So our mission is quite simple: democratize wealth creating tools for everyone, everywhere. Right now, not everyone has the same access to investment opportunities. I think that's quite obvious. If you are a multimillionaire, you're going to encounter certain opportunities that few have versus someone who is not. And this is, particularly true when it comes to DeFi strategies or pro trading strategies that most people just don't know and don't have the time really to learn. And this has also been a huge issue in DeFi in general. A lot of people complain, when is the next, super dApp going to exist that onboards the next billion people? But the issue is it requires a lot of education. And so our approach is simplify all those strategies that you would typically need to manually do by connecting MetaMask, using these dApps into a token in and of itself. So all you need to do is HODL. All of the strategies are embedded within the token itself, and you don't really need to focus on anything else, in which the token actually becomes the super dApp rather than the protocol. And so that's one of the ways that we hope to simplify financial literacy by increasing access.
All right, so yeah, let's walk through this. So a holder gets the token, and then underneath the hood, talk to us a little bit about what's happening. You guys are optimizing yield, or tell us what you guys are doing.
Yeah, absolutely. So step one, to your point, is that you would deposit some type of collateral like wrap Bitcoin or ETH or even Solana, and then you would mint what we call smart coins, right, or that next generation LST. And under the hood, it is taking that collateral, that principal, and it's doing a few things with it. Typically, it's implementing several strategies in parallel. These trading strategies can, one, be focused on minimizing risk. So, for example, our upcoming LST YBTC is principal protected, meaning that the Bitcoin that you put in, you can always take out. You will never lose that principal, which is really, really important, and also not a feature you typically see in most cryptocurrencies. Usually it's kind of just put it in and see what happens, right? I think everyone's gotten used to doing it that way. And then the second type of strategy is yield maximization, right? So how are you making money from this? This can be covered calls. This can be different types of arbitrage strategies. It can be arbitrage across lending rates, across perpetual future funding fees, a lot of different things that hedge funds have long used in traditional markets and also use in crypto that the normal person wouldn't be able to facilitate themselves. And it's the combination of these two things that allows people to hit specific risk to return targets, and also just get exposure to the cryptocurrencies that they already know and love.
So they pick up this smart coin. Is there, and you guys are running these two parallel strategies at the exact same time. Is there a specific amount of like APY that they can kind of corner in on, or is there a specific way where they can over index on a specific strategy, or is it like one strategy to rule them all?
Yeah, that's an excellent question. So typically, a single smart coin will be of a particular type. So that Y series, all Y series tokens, if it has a Y in front of it, effectively, it's principal protected at a minimum. And then usually one token will be associated with 4 to 5 strategies. And you can even do even more, but if you want to minimize the complexity and increase safety, usually 4 to 5. And those strategies are typically, they go through a lot of rigorous testing before we approve them, and in the future they're going to be approved by governance. So everyone understands, okay, what are the risks associated with the strategy, what are the gains, is this the best strategy that we can introduce, before them actually being added. Different tokens have different risks associated with them. So let's say, on the one hand we have YBTC. It's principal protected, has a 5 to 10% APY target, right? And then we could introduce ZBTC. And let's say the only difference between ZBTC and YBTC is ZBTC is not principal protected, so it's higher risk. But the benefit is that the APY target for ZBTC might be 15 to 25% yield, right? And that way people can self-select, okay, which tokens do I actually want to hold based off of what my own risk profile is. And of course, that token will have different strategies than others. So it's all based off of the type of token that you're engaging with. Of course, we have documentation for all of these things.
Absolutely. And I guess the way I'm thinking of this, and you can correct me if I'm wrong, but I think a lot of the audience will think of this as almost like a traditional mutual fund. Obviously, not exactly, but it's like, hey, you select a strategy. The token is actually your representation of ownership in this particular fund that's following a specific, framework, either being like mid caps, biotech, or what have you.
Yes, no, it's a great way to think of it. I mean, it is literally a crypto native structured asset, right? Or structured financial protocols, products. So just like you have this in TradFi, to your point, we can now create them in crypto. And one thing that's actually really cool is that there are a lot of strategies that are native to crypto that don't exist in traditional finance, like stacking points, via a pendle, or lending rate arbitrage between 2 different credit protocols that provide certain token rewards. And so this provides a lot more flexibility as to the strategies that you use underneath each token, without requiring the user to have to learn every new thing that comes out.
And in terms of the underlying, so you mentioned Pendle, friends of the pod, but it's been a while since I've done the Pendle episode. So I believe, and you correct me if I'm wrong, they're essentially originally focused on putting like interest rate swaps into DeFi, and then they've expanded. Talk to us a little bit about like some of the underlying protocols you guys are using to, produce this yield or like implement some of your strategies.
Yeah, so right now the main strategies are perpetual futures funding arbitrage with GMX, and several centralized exchanges, including Binance, OKX, and a few others. Soon we're doing a partnership with August Digital, to be able to integrate into the Morphos, Aves, Uniswaps, 1inches, etc. So effectively all the major dexes and lending protocols, and that unlocks about 18 strategies in and of itself. So effectively, the more protocols and the more centralized exchanges that you integrate across, the more strategies that you can execute in parallel. And then it just becomes a matter of, what strategies does the broader community feel comfortable upgrading into, each of these tokens. And that's actually one of the last things that I did want to say is that unlike an ST ETH, right, which pretty much doesn't change. I mean, unless Ethereum network makes a massive change in terms of the tokenomics associated with ETH and burning and stake rewards, it doesn't really change much. But smart coins can provide more protection and better yields over time if new strategies are implemented underneath them. And these things obviously are voted on governance, so they can evolve over time to become better based off of where the market is.
Absolutely. And you mentioned you guys have different kinds of coins. One that was mentioned was YBTC, and anything that I believe is prefaced with Y means the principal is protected. Talk to us about what other smart coins you guys have and some of the characteristics of them.
So right now we have YBTC, which again, principal BTC principal protected, and a yield bearing token, and it has a 5 to 10% yield. That's coming out this October. Ones that will follow will be YSOL, so same thing for Solana, YETH, and maybe YXRP. So really targeting those tokens that have a great deal of trust, or at least a great community behind them. And then later we'll see how aggressive this bull run is, but we have gotten inquiries on non-principal protected tokens, just because APYs are much higher, right? It costs money, to protect and minimize risk. And so typically that's why the yields for those tokens are lower. But those are the ones that are upcoming for sure.
Yeah, and talk to us a little bit about some of the challenges you guys have encountered while building out your platform for smart coins.
Yeah, man. Compliance and what's called trade execution. So, obviously, the regulatory world is catching up with crypto. And though I do still think it'll always be a half a decade behind, or at least initially, it's still really, really important to make sure that you're as compliant as possible. So, having the right offshore foundations that provide a compliance mechanism around the protocol, terms of use, risk disclosures, those make it so that you can actually enable both retail and institutional investors to take part in these tokens, and also ensure that those tokens aren't securities, in jurisdictions that I think a lot of the world follows, like Singapore, for example, or Dubai. And then the second is trade execution. So trade execution, basically in traditional finance, there is trade execution software that executes all of the trades and the strategies across all the banks in the world. This type of software does about $1.9 trillion in volume per day, so it's incredibly important. This does not exist in crypto. There is no trade execution software that is integrated across all the different liquidity venues, the protocols, the sexes, centralized exchanges, etc. And we had to kind of build that from scratch, and that was quite difficult, because on centralized exchanges, you can connect to an API and transactions are final, right? Everything's pretty much off chain, or between master and child wallets. But on chain, transactions are probabilistically final, and they might not execute on time. And if they don't execute, then you might have to change that entire strategy, right? Because every millisecond matters. And building that is quite difficult. But the benefit is that it creates middleware that's not only usable by Umoja, but in the future, if we're successful, can be used by many other protocols in a lot of different ways. So that effectively anyone can structure their own products, not just based off of DeFi protocols and other assets, but based off of tokenized RWAs and stable coins, etc. And so it opens a huge opportunity that's just as big as what we see in traditional finance, which I believe that market's around 1.7 trillion now, and forecasted to be 3.4 trillion by 2030.
So the regulatory risk and kind of being regulatory compliant was the biggest trick or the biggest difficulty for you guys, you think?
Yeah. It's, I mean, the expenditure for memorandums, which are effectively plans to be compliant, and then implementing those plans, I would say is hundreds of thousands of dollars. And a lot of it is greenfield, right? A lot of these things, you have lawyers that obviously are very skilled, but they have never come across assets that test the boundaries of the law in the way that they do, right? To have a yield bearing asset that's not a security is very much a new thing in the world. And proving that it's not security is it's even more difficult. And so that's definitely something that you want to stay on top of, because at the end of the day, if you do have aspirations to be a $1 billion protocol or used by a whole bunch of users, you will be seen eventually. So to assume that you don't need these things is probably the wrong assumption.
Yeah, absolutely. And then if you're spending like, hundreds of thousands on regulatory compliance, I'm assuming you probably raise like, whoa, maybe a seed round, Series A. Where are you guys at in the
Uh,
fundraising?
s- yes, so we recently raised a $6 million seed round earlier this year. Likely going to do a $1 million strategic round with typically crypto hedge funds or financial firms that have introduced crypto-based structured products in the past. That are very kind of value aligned. Because the biggest thing is that we want to make sure that this provides value both to institutions, which typically drive volume, even on the Uniswaps and Aves, et cetera, but also is globally accessible to retail. Because if you have all of these obstacles like doing KYC and all these other things, then it kind of invalidates the mission that we have, right? And so both things are quite important.
Yeah, so let's talk a little bit about like what you guys are. What are your guys like real next steps? Is it using the funds that you will raise to roll out more tokens? Is it to try to, increase the marketing budget and just try to get more people using the platform so you get like a bit more market feedback?
Yeah, so the next steps for us is we're entering kind of phase one of smart coins for YBTC, which means a $1 million AUM cap or TVL cap, right? So taking baby steps before you just open the door and let a whole bunch of capital in, which can cause a lot of issues. Making sure that we have insurance in place to cover any smart contract exploits if money is lost, and also a ton of audits, right? And that's what phase one is about: is getting capital in, taking baby steps, making sure everything is as ironclad as possible. Phase two, over the course of November, increases that cap to 10 million, and then it's uncapped going into December forward. Of course, introducing more smart coins beyond YBTC is definitely a priority. But more importantly, is expanding the liquidity ecosystem for these assets, right? So it's great to have a high yield, low risk token, woo woo, but it's even better if that can be used as collateral to a lending protocol, because then you can top up existing strategies that people are already using to monetize their PTC, their SOL, etc. Or even better if it can be restaked in a restaking protocol or has deep liquidity pools on dexes. And so a lot of our focus is going to be expanding the liquidity ecosystem for these smart coins. Obviously increasing AUM on the protocol itself, and then of course we have our own native token that provides a performance fee rebate to stakers within the smart coin that they have. And so that's obviously a focus as well.
And you'd mentioned earlier that kind of community feedback shapes the like token ecosystem. Talk to us a little bit about like that mechanism where the
Yeah,
community.
yeah. So we have a community, I would say, community of around 80,000, but an active user community of around 20,000 in what's called the factory. And the factory is like Umoja's fight club, per se. Like those are the DJs all the way down, giving us the most feedback. And really it's asking them, one, what do they want to get from an APY perspective? And then two, do they have risk concerns? Because you'll be surprised, like because so many people are used to either making 10x or 1,000x in crypto or losing everything, a lot of people don't have risk expectations in terms of protecting anything. And there's actually, I'm forgetting the name for it, but typically in macroeconomic recessionary conditions, people are more poised to gamble because they have so little. And so it kind of makes sense. It's like, well, if I have $1, if I lose $1, okay, great. But if I make $10, then that's even better. And that's why we saw, I think, in my opinion, meme coins be the macro theme for crypto at the beginning of the year, because we were coming off a 2-year crypto recession or depression, basically, after FTX. And so, one part is obviously getting the APY expectations, but the other part is like, do these safeguards actually help you? Do you find value in these things? I would say the second thing is just providing other earning opportunities. So in the factory, we give away $3,000 USDC to the most active contributors to the community, whether they're referring to increase the community size, sharing content, creating content, and so effectively employing the community in a decentralized way that will continue when we do governance, as well as facilitating ambassador programs. So it's really important not to just create mechanisms for wealth and the tooling that you're creating, but also starting to decentralize the work that the team is doing, because at the end of the day, that's what the ultimate status of the protocol should be. This is that anybody who wants to work for the protocol or make it better should be compensated as such, rather than it just being a volunteering based thing.
Yeah, it's funny you bring up the meme coins. I often wonder what is the like rationale behind that. I chalked it up to kind of financial nihilism, whereas if you've been around crypto for a while, that you're like, all right, I've seen like 40 projects say they're the future of finance. Like at this point, I'm just gonna buy a cute dog.
Yeah, yeah. I definitely think there's part of that as well. The utility token era is currently it's pretty bad right now in terms of people's belief in utility tokens. And I think the main reason is that one, I don't think a lot of teams understand tokenomic design, because tokenomic design has been summarized as what's your listing price, what's your fully diluted valuation, what's your IMC. But that's not what tokenomics is. It's incentives. It's game theory. It's how are you using a bootstrap incentive to magnify the value proposition of the protocol itself. So if you have a credit protocol, then how is this token maximizing the number of loans that you're dispersing and minimizing the default rate, right? That's what the token should do. But oftentimes it's just stake and get more of this token, which creates inflation, which makes things effectively go down. And if you do that 1,000 times, to your point, with all these different projects, then yeah, but I mean, buying a dog that you know is pumping, at least you know it's going to pump at some point,
Yeah.
right? And so that's definitely been a part of our narrative on the token side. Is there is a predictive value for the underlying token when you associate it with performance fee rebates and other things. Yeah.
Yeah. Now, finally, where can people learn a little bit more about what you guys have going on, connect with you personally online?
Yeah, absolutely. So at Umoja Protocol, UMOJA Protocol on Twitter, and at umoja.xyz. Join the factory. You just go to umoja.xyz, look at where you can earn points. You can join a huge community, complete different tasks, get paid to do those tasks, right? We value your time, and also just learn more about how you can join the team and make change.
Absolutely. Well, thank you so much for coming on the Building Web3 podcast. Everyone go get involved with Robby and everything that's going on with smart coins. Let's continue building the future of Web3.